All right, well, thanks, Lucas, for the introduction. Again, my name is Tyler Giering. I've been providing various roles of asset management for some large institutional investors for over 5 years now. These owners have had anywhere from 30 to 70,000 doors. And up until about 6 months ago, I took a position with a company called Tactical Asset Management. Tactical has about 3,000 doors right now. They're growing rapidly. A lot of our clients are within the ThinkMultifamily group, as well as we have some within Nighthawk Equity, Michael Blanc, some of you might be familiar, and some individuals as well. So what is asset management? Well, asset management is typically anything that happens from acquisition to disposition. That's, in the asset manager is steering the ship. Multifamily is not a passive investment for the sponsorship team, for the limited partners. It certainly is. For the sponsorship team, especially if you have a lot of partners, if you have asset management responsibilities, it's far from passive, hence the asset management role. So I'm going to go over just some key metrics and some tools and tips we use at Tactical Asset Management. I've worked with, like I mentioned, a few different companies, and asset management is done different company to company, but I'll show you what we like to pay attention to at Tactical. So starting out, you're leasing and advertising. This is your revenue driver, so very important. If you can't bring tenants in to lease, you can't create revenue. The typical sources, a lot of your leads are going to come from your online advertising, so that's typically your apartments.com, your RentPath, Facebook Marketplace, Craigslist, a property-specific website. Additional sources would be your walk-ins, referrals, word of mouth. If your property is located on the side of a very busy street, freeway, you're going to get a lot of leads just from drive-ins and things like that. But traffic is, in general, very location and property-specific. So there's no one-size-fits-all. And it's the asset manager's role to track these different leads, as well as, so we're tracking all these leads ongoing, and we're allocating our advertising dollars accordingly. And one tip I'll give you is to periodically cancel and renegotiate your contract, especially for some of those online advertising sources like apartments.com. We recently just canceled one, especially if you have high occupancy and you're using a couple of them, just cancel them and renegotiate. It's a good way to bring those advertising costs down. But we recently just canceled one with apartments.com and renegotiated. They gave us 3 free months and then half price for the next 12 months following, so worth your time. This here is our Monday morning report. So we send this, this isn't the actual report, this is the data that we input into our database from the report, but hence the name. It's a report that goes out, or comes into us every Monday morning, provided by our property managers. And starting on the left there, the date, and then anything to the right of that is going to be a calculation of your physical occupancy. So that includes total units, any office model employee units, and any down units. So, and then that will calculate your percentage occupancy and your vacant units. And then going to the right, your pre-leased vacant units and total notice to vacate. That'll calculate your leased percentage, so that's your forward-looking occupancy. Another important metric to pay attention to, if you notice, for this example, our leased occupancy starts at 97%, and then a couple months later, it drops down to 90%. And that's actually intentional. This is a deep value add deal. So we're coming in there and we're getting aggressive with our renewals, and we're trying to create turnover so we can get in and renovate those units. The next column over, that's your market ready units. Another key tool to pay attention to, just because this is a great way to understand if you have a bottleneck with your maintenance staff and maybe they're not able to renovate units fast enough and you may need to outsource them, or you may just need to have them prioritize unit turns. So for example, at the bottom there, there's 5 market ready of our 11 vacant units. which is pretty good. But it's just good to track this, and it'll help you know where to dive in and dig deeper. We also track collections and delinquency. So in general, with the value add deal, you're changing the resident profile. So you're turning about 90% of these units. So you should see over time your delinquency trending down and tightening up. And if it's not, there are some questions to be asked, and like you maybe have to tighten up your criteria for new residents. But overall, we're tracking these things, and one note I'll make is just not to expect your PM to make proactive changes for you. A lot of times I'll get a deal and it'll be 100% occupied and we're charging concessions. So it's my job as an asset manager to come in and say, hey, that's the market telling us that there's a lot of demand for our product and we're giving it away at a discount essentially. So we would cut those concessions, or sometimes when a PM hits 100% occupancy, they're like, okay, my job's done. I can step away. I'll lease all the units, but we'll increase that rent and keep it moving.
So the one on May 3rd, so I'm looking at it, and it's got a decent occupancy rate. It's like 93%, but the collected rent is $28,000, and the current delinquency is $106,000. So would that be indicative of like needing new tenants? Or
no, yeah, that's just based on the timing. So that's the beginning of the month, and essentially we're factoring in the next month's rent. Or this is, I think you're looking at the 3rd, so that would be most residents pay their rent on the 5th. So we haven't collected that yet. So it's a bit of a moving target, but overall you want to trend. You want to watch what's collected by the end of the month, and that trend over time. Loss to lease. So this is just a simple calculation of loss to lease if you're not familiar. That's the difference between your lease charge, what's actually on your lease, and then the market rent. So that's what you're able to achieve at this time for a similar unit, or what you're advertising for on like apartments.com. But for this example, our lease rent is $700 and our market rent is $800. So we have $100 in loss to lease. And I like to call that the low-hanging fruit. So you can essentially go in and just increase the rent and recapture that. So when I get a new property, that's one of the first things I pay attention to, and I calculate the loss to lease on all of our units. It's not uncommon to find $200-300 in loss to lease on some units. The market's been rising quite quickly. We've had a lot of rent growth, and sometimes our renewals will lag behind that rent growth. So if you have a long-term tenant, you might have a lot of loss to lease. We're going to go through and try and recapture some of that. And just because you increase that to market doesn't mean a resident's going to necessarily move out. If they're probably going to go online, go on apartments.com and check what rent is, check their alternatives. And if that is truly the market rent, they're likely to stay. So one way we compress loss to lease and keep it compressed is this is just a tool based off our rent roll, but it outlines all of the units that are within 120 days of expiration. And then the third column from the right there, that's our suggested renewal. So we provide this to our property managers. So it really takes out the ambiguity in where renewal should come in, and it helps us compress some of that loss to lease. So we'll provide them with suggested renewals. And again, there's other reasons for loss to lease. A property manager may be given a buddy discount, or they may actually put out the renewal at a certain rate, but then the resident will come in and negotiate and they'll walk it back. So we'll provide just firm guidance, and then we'll have our VA go through and check and see if the rents came in actually close to where our renewal guidance was, just a way to keep that loss to lease down.
VA is virtual assistant, right?
Yeah, correct. Unit renovation tracker, this is very important. So it's typical on a value add deal, which is the majority of our portfolio, that you're spending $5,000 to achieve a $100 rent bump. And just because you put that in your business plan doesn't mean that's reality. So we want to pay close attention to what we're actually achieving. on our renewals. And if you, back to loss to lease, so the discount / premium to market, that's essentially our loss to lease. So we have $217,000 we can essentially recapture in loss to lease. But what I want you to pay attention to on this slide would be your average upgrade premium on the far right. So for our 1-bedroom, 1-bath, large floor plan, we're achieving on average $143, which is a great premium. We're gonna keep rolling with that. Our 1-bedroom, 1-bath, small floor plan is achieving on average $100, also a great rent bump. But our 2-bedroom, 2-bath upgraded unit is only achieving $54, which to me is not a great ROI. It's the most expensive unit to upgrade because it's the largest square footage, and it's achieving the lowest premium. A $54 rent bump is not great to spend $6,000, $7,000 on. So based on this analysis, we put that upgrade on hold, and we're gonna reallocate those funds to higher ROI items. But it's one other thing we do is if we go into a market and we don't really know the rent, we'll sometimes test a deluxe unit as well as a premium unit. So your deluxe is maybe $2,500. It's just paint, vinyl, just some light updates, and then your premium that may include your cabinets or new appliances, things like that. But we'll test that, and in some markets we've actually found that we can get the same rent bump for a deluxe renovation as our premium. So this kind of analysis will save you a lot of money. So in that scenario, we were saving $2,500 by not moving forward with the premium units and just keeping the deluxe. And if you have a large property, that can make a huge difference. Project and cash management. This is another big portion of my job, and on any value add deal, there's 10 to 30 projects going on. If this is a screen grab, but if you could scroll down, the list goes on and on. So I'll just walk you through this, starting on the left, building area, so that just labels our interior, exterior. Description of work, that's your exterior paint, tree removal, putting in a playground, things like that. Lender reserves. When we do a value add deal, we try to have the lender provide us as much as we can in terms of funding. So if they'll provide us with rehab, that's when you'll see those lender reserves. And the way it works is we pay for the expense up front. Example, we'll put in the playground, and then the lender will come out and inspect, and we will make a replacement reserve draw. And if their inspection goes well, they'll fund the money, but we need the capital up front to pay for these projects, which is called our working capital. So that's something we pay close attention to. We want to make sure we always have enough working capital, because if you run out of working capital and you're constantly waiting for the lender to fund, you'll quickly turn at what would start as a 12-month project into 24 plus months, and it'll really crush your returns. So we're paying close attention to that. Moving along, your budgeted costs, your actual costs, so this is just general project management. Status, in progress, complete or done, and then the start date, completion date, and then your budget versus actual. So we're, a lot of project management, and then on the far right there, those are our draws. So those are our draw requests to our lender. But what I want to point out is just your cash is always a moving target with all these projects going on. So a lot of my job is not only project management, but keeping adequate cash queued up for new projects coming up, and then promptly completing replacement reserve draws. And we're forecasting other things like investor distributions and things like that. So again, on project management, we have weekly phone calls with our property managers. During those weekly phone calls, this kind of serves as my to-do list, but this is my project list. So starting on the left, those are projects, the status, again, in progress, not started, done, completion date, your project team, any action items for myself, and then notes. So this is just a great tool, because if down the road when you're going to go to refinance or sell a property, you're going to have to provide the broker or the lender with a lot of information on what you've done. And when you have a large amount of deals like I do in my portfolio, there's tons of deal merge and it's hard to remember. So this is just a great way to track and keep track of everything that's ever happened at the property. As well as investors, we're going to ask questions, and this is just a great resource to utilize. Managing the unexpected. So value add deals come with a lot of problems and a lot of upside. That's why we like them. But being a good problem solver is key. So, things happen a lot, quite frequently at these projects, and it's an asset manager's job to solve them promptly and cost effectively. And these issues will range anywhere from a water leak to a homicide. And I'll give you a couple examples. I was managing a property in Philadelphia, and I was in the process of a refinance. I had the lender on site. I had the physical needs inspector on site, the environmental, all the third parties. They were all there, and someone drove by and threw a Molotov cocktail through the office window. So
You were there?
I wasn't there, but all these other people were there. I got the phone call. And luckily everyone was okay, and after some renegotiation, we did refinance the property, but just goes to show you there's just always, I would certainly classify that as under the unexpected bucket. I didn't forecast for that. But another one, gates, it should arguably be expected at this point, but for whatever reason, residents just love to run in the gates. They'll run in the gates over and over again. And they'll run in the buildings. We just had one run into a building. They made it into the building. There's just, things come up, and it's the asset manager's job to, solve these issues promptly and cost effectively. Additional value add opportunities. So this is probably the favorite part of my job. There's typically always a way to add value, especially if you have cash in the bank. There's just so many different ways to add value, but a couple ways we at Tactical Asset Management add value is through leveraging our portfolio size. And I'll give you a few examples. One, if you pool enough insurance policies together, you can achieve a discount. It's called a master insurance policy. So this is, and after talking to we're doing this on some of our properties, but after talking to some loan brokers, I found out that after we hit 10,000 doors, we're going to achieve a much larger discount. And that's just something that we can pass on to owners. From day one, they can come in with an expense reduction. So that's great. Another way we've been able to leverage our portfolio size, there's this company called Rhino. What Rhino does is they essentially replace your security deposit with an insurance policy. So there's really two main benefits to that. One, we can advertise the property, move in, no security deposit. So we essentially get more traffic that way and more leads. And two, we're using them on some of our Memphis portfolio, where our average security deposit in Memphis is probably $300. So you spill on the carpet, you break a couple of blinds, you're quickly at $300. Anything outside of that is hard to recoup after a resident moves out. So this is kind of a nice hedge against our some of those costly move-outs. And the reason I put it under leveraging portfolio size is because this company was actually not in the Memphis market, but due to the amount of units we were willing to provide them there, they decided to come into the market. One more example of leveraging portfolio size would be we just bulk ordered 140 HVAC units. We work with the supplier all the time, and we were able to negotiate $300 discount per unit, so over 40K off right there. And not only that, that's not even the end of it. They allowed us to store our inventory in their warehouse and that's huge. We're installing 10 units on average a month, so that it's going to be there for 14 months. And to put it in perspective, if you go to a C-class asset, it's not uncommon to see the AC condenser actually chained up outside because people will steal them while they're installed. So I can only imagine what would happen if we put 140 of them on site and installed them over 14 months. So that was huge. researching new amenities. There's a lot of new technology coming out. It focuses a lot on A-class assets, but there's one in particular that I'm excited about. There's a company called Gigafy, and Gigafy is essentially a profit share internet service provider. So Gigafy will come in and run fiber optic cable to your property and then wire each individual unit and equip them with a wireless router. So it essentially gives your property manager the ability to, at the click of a button, have internet at any unit. So we sell internet to our residents, and it's a great amenity to provide because for a number of reasons, but one, it's convenient. So the resident comes in, by the time they get to their new apartment, they already have internet. They don't have to wait for the technician to come out. Two, there's no annual contracts. So it's a month to month. They don't have to sign the 1 to 2 year Comcast agreement. It's flexible. We'll give them the first month free. And not only that, it's high quality. It's brand new fiber optic cable wires.
And they pay you?
Yeah. So they'll pay us. We're paying Gigafy to install the equipment, and then we charge the resident what we want. And on that topic, we'll undercut our competitors, which is usually Comcast. So we'll come in maybe $5 lower. So it's a great amenity to provide to your residents because it's not only a cost savings to them, but it's a really solid amenity and very convenient.
And then does that go on the NOI of the property?
Yeah, and that's the reason we like it too, from an owner perspective, is it's a huge ROI boost. So on average, we're spending $490 to equip each unit, and we're achieving a $40 premium. That's what we're keeping at the end of the day for the internet per unit. And to put that in perspective, we typically charge $5,000 to upgrade units for a $100 premium. So in this scenario, we're spending $490 for $40. So it's a great ROI. Great ROI. We love it. We're rolling them out at, I think, 12 properties right now.
Is that available in many markets or just select markets?
It's available anywhere. So they'll come out and do a market assessment to make sure that there's, essentially that there's enough qualified residents that will like their product at a reasonable price. But they do require 80 plus units to put it in. So if they're going to run the infrastructure, they want a relatively large project. Communicating with investors and owners. I put Patrick Duffy up there. He's the founder and CEO of Tactical Asset Management, but he's also kind of the staple of good communication. For those of you in the Think Multifamily group, you already know that, but he actually studied communication at Harvard, and it certainly shows. But overall, your investors have built a lot of trust. They've trusted you with their money for 5+ years. So you want to be communicating that you're actively seeking opportunities to increase their returns. You don't want them to get the feeling that, hey, we've collected your money, we've closed the project, and now we're moving on to our next project. That's the asset management role, so that's what we're trying to communicate. And one way we do that is through monthly investor reporting. So that these reports will typically include your financials, project updates, maybe some pictures, and just any narrative, anything we think was important to add in there. And included in your financials, that's a budget versus actual on a monthly basis. And that's, we could do a whole speech on that alone, but that in general is kind of like a scorecard. So it'll outline any areas where you're doing well, as well as any areas where you can improve. For example, if we're high on our marketing costs, we may want to pinpoint our top 3 sources, tighten up on that, and then again, like I mentioned in the beginning, maybe renegotiate that contract. Additional items, so now that it's the beginning of the year, we have a lot of annual reporting. There's tons of IRA reporting, lender reporting, ongoing investor questions, things like that. That's part of a typical asset manager's job. We also provide quarterly site inspections and more if needed. So we will typically provide more at the very beginning of a big value add project. When you get a lot of projects up and running, you want to go in and monitor the quality of construction. Trust but verify, we like to say. So I'll give, for example, like on our unit interiors, I'll give a contractor 2 units to renovate, and then I'll fly out and I'd like to inspect them and just inspect the quality of construction. Maybe they'll knock it out of the park the first time, but we found some, sloppy construction quality, and it's just good to set an example. We found a number of things, painting over brand new cabinet hardware. We found drywall screws in the side of your brand new cabinet, things like that. So you just want to set an example and a template really before you give them the remaining 100 or so units. And that goes for any projects that we're implementing. As I showed you on the project list, there's quite a few. So when I go on a general site inspection, I like to focus on the high cost items. This is just your roofs, your foundation, drainage, things like that. It's not uncommon to go and see the gutter downspouts that are wrapped around and diverting water right back into your foundation. So just be paying attention to things like that, as well as potential hazards and deferred maintenance. If you spot any deferred maintenance that you didn't already know about, you're going to want to build that into your replacement reserves and just make sure you have adequate funding later on when you need to cure that deferred maintenance. One tip I'll give you is to show up unannounced. Typically, a property manager is going to clean up and the maintenance staff are going to clean up a little bit before the owner or the asset manager arrives. So it's nice to every once in a while, not every time, just periodically just show up unannounced and just see how the property actually looks, like how it would look for a resident when they were coming there for their first time. And some things I found on these site inspections, we used to have annual site inspections for the last company that I worked for, and I found the property manager was installing purple light bulbs throughout the property, which I wasn't a big fan of. And we had this huge A-class asset in Savannah, Georgia. And so it was a nice project. It was 500 something units, big property, a lot of amenities. And the first thing you see when you walk in is a fireplace, some nice furniture, and a kitchen. And the kitchen is an example of what their units look like, the kitchens in their units. But the maintenance staff was actually removing the faces of the cabinets and replacing broken ones in units. So when you walked in, all the cabinet faces were gone. The sink was actually, he pulled it. Instead of ordering the new part, he just pulled it from, the first thing you see when you walk in the office. So things like that, certainly pay attention to. Yeah, that's it. So I'm happy to go through anything more in depth or answer any questions you have right now. If not, that's my contact information. Feel free to reach out later on.
So what's the biggest mistake you see people making trying to do it on their own, like asset managing on their own?
Just not having the proper systems. Like we're looking at a lot of things. That's just a surface level. That's just showing you like a lot of those tools. They go a lot more in depth. But in general, just not having systems or knowing what to pay attention to, because a lot of the clients that we get or have tried it themselves, and either they didn't like it or they're just not good at it, and that's why they hand it off to us.
So I think when I first got started in multifamily, I couldn't imagine how someone would let like a multi-million-dollar building fall into disrepair or something. But it happens a lot easier than.
And we're buying them. That's those are these value adds, right?
It's value adds.
Because it's just poor asset management mixed with poor property management. Well, it's the asset manager's job to hire the property manager, so it's essentially poor asset management.
So one question I had is, you were talking about how the property manager usually is not proactive. Do you guys have rules in place where it's like, okay, if you hit X occupancy, a trigger happens and you automatically increase renewals $50 or $25?
We're taking a lot of things into consideration, but in general, if we're near 100%, we're going to look at increasing occupancy or increasing our rents. But no, we don't have like a rule of thumb. But some property managers will be proactive. I'm not saying all of them won't, but it's your job as asset manager to make sure that they are making those proactive changes. And that's why we have that our Monday morning report. So we're tracking occupancy on a weekly basis. So we're pretty in tune with what's going on. And not only that, I showed you our leased occupancy, which is kind of our forward-looking occupancy.
Do you guys work on smaller properties?
We like to do 80 plus. We have some clients that have a couple below that that we've taken on, but other than that, we're looking for larger